mentioned earlier to some people here, in one of the big City of London law firms. I spent my career there 33 years, then I was a partner for 26 years. And I was involved also in developing new law through professional committees. And I was involved, shortly before I retired, with a group of international lawyers advising the South African government, the TTI there, on their new Companies Act, turned out to be Companies Act 2008. So I've written and lectured a lot on legal topics. And then I came across Michael, and a lot of what I've done in practice, which is a corporate and finance practice, was turned on its head by looking at it from a relational point of view, which was challenging, exciting, and extremely interesting for a sort of retirement, semi-retirement project. So I'm very grateful for you all coming, and particularly all of you with interest in relational thinking. And what I'm proposing to do is talk a bit about some of the problems there are in the corporate world in this country, and you recognise it in your own country as well, I'm sure, to a certain extent. And then to look at some of the background, look at the causes of some of this, and then talk about where we are. Michael mentioned this in his introduction this morning, in government terms as to what's happening. I thought the doors were opening, but sadly, for political reasons, they've been rather closed again. And then give you a suggestion for a movement. I suggested as a Christian movement. It doesn't need to be a movement by us. It's all about popular voting and popular action these days. Us taking control of this and actually saying to big business, we don't want this. We want you to operate on a stakeholder inclusive basis in the interests of everybody, not just short-term financial return for shareholders. So if you want to interrupt, do interrupt. I've got quite a lot to get through, but I hope there'll be lots of time for questions at the end. So here's a question for you. What should we expect of big business? I'm talking particularly about large corporates here. The smaller SMEs, privately owned companies, are easy to turn around as long as you've got the management and the owners. But large corporates is different, obviously, because you've got a wealth of shareholders and companies operating within a market. So what do we expect of big business? Well, is it just a question of supplying us with food, clothes, medicines, IT, train, car, air transport, utilities such as gas, water, electricity, research into new drugs to improve our health, banking and financial services, helping us to have credit cards and mortgages to buy a house, everything we need for our expected standard of living these days, and we're very demanding. A lot of things we don't need, but they're still there if we want them. Of course, companies also, we expect them to provide employment, careers for people, pensions, and opportunity for investment by shareholders and others. So without large companies providing all these things, much of what we need, the modern standard of living would either collapse or certainly be severely depleted. But the question is, should we expect more than this? Should we expect that big companies should have a responsibility to employees, to pay them properly, to listen to them, to suppliers, to pay suppliers on time, to look after the interests of suppliers, to work with them in a partnership, and also customers, beyond purely financial return, and also should there be a responsibility to society, corporate social responsibility, should companies pay taxes where their profits are earned to help to support and fund the stable society in which they operate. After all, you could say that the word company comes from the Latin cum panis, which means breaking bread together for the benefit of everybody. But the question is, are companies operated in that way these days? We rely on these companies, and they rely on us, of course, for their sales and supplies. We deal with them directly every day. We may not think about that, but they seem to be remote entities for most people. They're not answerable to society. For instance, the banks, certainly people feel that. We have no control over their activities, or do we? And that's the question. So what's the worry? I mean, you could say, well, these companies are operating fine, we can buy all our goods and services, we can get fairly cheap food in the supermarket, so what's the worry? Well, a very good book written by Colin Mayer, who's at the business school in Oxford, his book called Firm Commitment, said, the most important organisation in the world is the company. The modern corporation is a miracle, one of the most ingenious concepts ever devised. And I'm going to explain that in a minute. However, he went on to say the corporation has lost its purpose and become dominated by short-term financial concerns to the exclusion of all others and to the detriment of us as customers, employees and communities. Now, I think that's so true, and I think people often belittle this and say it's a few bad apples. I don't think it is, and I'm going to explain some of that now. Look at some of the examples. There's been significant voting in this country at AGMs against senior executives in many companies over the years. And recently, this year, AstraZeneca, Crest Nicholson, building company Drax, Morrison Supermarket Group, Pearson, WPP. There's a discussion at the moment in the press about a proposal coming to the AGM of Berkeley, which is one of the biggest residential home builders, where the proposal is there should be a pay package worth 92 million for the 6 senior bosses in the company. And just look at the figures. Martin Sorrell at WPP earned recently £70 million in 1 year. Reckitt, the senior person, owned £23 million. Shell, 19 million. Tesco, 4.6 million. Now, my question is, do those leading large companies, large listed companies, really want to be remunerated in that way to incentivise them? Surely they should be well paid, I accept that. But much of the reward of leading a large company is the satisfaction of developing a successful business for the benefit of shareholders, employees and others, and the reputation of that company. You'll be pleased to hear that it's going slightly down now, these figures. A report by Deloitte recently, last month, said that the maximum allowable bonuses in the biggest listed companies has dropped from 600% of base salary 4 years ago to 450% of base salary. Now, out of that, of course, the particular issue is not necessarily the level of the amount of remuneration, but that is fairly significant. It's pay differential. Theresa May, our beloved Prime Minister, in her own manifesto before she was chosen as leader of the Conservative Party, referred to executive pay trebling over the past 18 years and the unhealthy gap between what these companies pay their workers and what they pay their bosses. The High Pay Centre reported recently that the FTSE 100 chief executives, that FTSE is the biggest companies listed on the stock market here, they're paid on average 130 times more than their average employee, 130 times more than the average employee, whereas in 1988, the figure was 47 times. Now, what's the justification for having such a significant increase of the pay differential? What does it say to a low-paid employee with a responsible and stressful job, say a person at the supermarket checkout desk who has a difficult job, they've got to concentrate the whole time, they've got difficult customers, not necessarily making life easy for them. What does it say to them? Their bosses are paid hundreds of times more than they are, about the value of their job to the business and how they as individuals are valued and respected. It can create disquiet and enmity within the organisation. What about treatment of employees more broadly? The latest figure I read said that 900,000 people are on 0-hour contracts. Now, some of them may be fine because they're more like consultancy arrangements, but the bad 0-hours contracts, and there are a lot of these around, is where people are obliged, they are technically employees, they're obliged to be available at any time to be called into work, and they can't take on any other jobs, they have to be available. And sometimes you hear stories about them turning up, travelling some distance to work, saying you want it today. They get to the door of the factory or whatever, and they're told, no, there isn't any work, so they go away, and they're only paid on a time basis. Certainly Labour wanted to ban those, but I think the Labour Party, what we need to look at is understand the nature of the contracts in different circumstances, because it does suit some people, but it's something which has been discovered recently and is not a generally good practice if people are restricted from getting jobs elsewhere. Salary levels, of course, as we know, are generally below those of 10 years ago in real terms, and it's very political now at the moment with the public sector workers calling for pay increases, because it's one thing to say you don't get a pay increase if inflation is zero, or virtually zero, but inflation is creeping up and people are falling behind. A few years ago, one of the trade unions reported that 60% of Sainsbury's employees were on government tax benefits. That meant that we as taxpayers were subsidising Sainsbury's, which is a listed company. And employees don't feel incentivised, they're not consulted, they're not engaged in the business, so it's not surprising that productivity is low. There's great pressure on employees that there's a prosecution going on at the moment at Tesco for some people who booked income from suppliers earlier, which led to a black hole of 326 million. Now the question there, I'm going to be slightly careful what I say because this is being recorded. There's a question there of their motive. I don't know that they were motivated by bonuses. Why did they feel under pressure? Why would they create false accounting in that way? It does show a breakdown of understanding relationships between employees and senior people and what the senior executives are trying to do for shareholders. There's a report in the paper recently that Amazon employees have to walk at least 10 miles each day walking around the warehouse collecting orders from shelves to meet the targets. And they have very significant targets about not turning up late, not being ill, and if they're the wrong side of the target, they are disciplined or they can lose their jobs. What about suppliers' treatment? There's some staggering statistics that there's a very significant number of large companies do not pay their small suppliers on time. And the small companies that are supplying very often aren't in a position to negotiate because they rely on the big company, the big supermarket or whatever. Recently it was reported that 40% of UK small and medium-sized enterprises were paid beyond the agreed payment date by the customers and clients. Now the agreed payment date will be dictated by the customer, by the big organisation, which may be 60 days, maybe 90 days. There are all sorts of stories about companies extending their time scale for paying suppliers without necessarily consulting them or agreeing with them. And at the moment, there's something like £26 billion outstanding in late payments to suppliers, which in effect, of course, uses the supplier to provide free credit to the customer, to the company. And what does that do to the cash flow of the supplier? There's a report that something like 50,000 small businesses went out of business recently over the last few years as a result of late payment. There are examples, again, in the press, a demand by a company to a supplier to pay up to £25,000 for a table for a charity dinner. And apparently they said that if you're not prepared to pay that as a supplier, your name will be on the chief executive text on Monday morning. There's also reports that perishable food supplied to a company wasn't recorded on delivery, but was allegedly sold by the supermarket, but because it wasn't recorded properly, the supplier wasn't paid because they said they hadn't received it. Another example is if a customer complained to a supermarket, there was an automatic charge on the supplier of £55. So that could be bruised fruit or not liking a ready meal, apparently, so this report said. Morrison's, again, reported in the newspaper, asked sums averaging £2 million each from dozens of suppliers to keep stocking their products. And Tesco and Boots asked suppliers to pay back 2.5% of the turnover with them. So they'd agreed a price to buy their goods and they just imposed a reduction of price. And then a lovely one, Majestic, the wine store, they asked their suppliers to pay a whole lot of money to build a new warehouse for the wine. And they said, well, hang on, we supply you the wine, you pay us for the wine. And they said, oh, well, this will encourage our purchasing from you because there'll be a nice new warehouse. This is all allegedly and in the newspapers. Customer service, well, we know this personally, don't we? It's very often too impersonal. You go through several layers of phone messages, typing in numbers and so on, and slow, inefficient complaints procedures. Debt levels, well, often too high. I mean, I just have this example, it's a bit old now, but when Kraft, very political, this takeover, it's no longer called Kraft, is it? Bought Cadbury, the originally British food manufacturer, chocolate manufacturer, which was a listed company. They borrowed $9 billion to fund the purchase. Now, where does that cost go? It goes down the group. So obviously they have to service the debt, they have to repay the debt, and that could cost jobs and increase risk in the operation of the company. And there's also the issue of companies borrowing too much money because they're effectively handing control of the company over to the debt holders. If companies get into financial difficulties, and I saw this as part of my practice, then the shareholders are put to one side and the debt holders convert their debt into equity. So there are some examples where the shareholders are left with less than 1% of the equity of the company because the debt holders they take over ownership of the company. So of course, as we know, if you get into debt, you're effectively handing over ownership of yourself to the person who's provided debt to, you're handing over the control. Then of course the low level of tax paid by multinationals, Amazon, Apple, Facebook, Google, Starbucks. So that means, of course, I would argue, that they're not contributing to the society in which they operate, paying for the infrastructure. They pay for it in PAYE and so on, other terms. But you could easily say that they're putting competitive advantage to local companies that do pay their taxes. For instance, Amazon supplying books, which is very, very difficult for local domestic book shops which are earning profits here and paying their tax here to compete with Amazon, which doesn't necessarily pay its tax in this country, might reroute it to Switzerland or into group pricing and so on. One of the fundamental problems here is the demand by shareholders for short-term financial return, dividend payments, share buybacks, and wanting a share price increase. And this, of course, this is where it all starts to combine. But we are shareholders in these companies. I think virtually all the British public were shareholders in BP through their pension funds and other investments. And last year, UK listed companies paid £84 billion to shareholders. That's through share buybacks and dividend payments. And that's up by almost 50% on 2007. And I don't think that's just a question of companies being more successful. So some of these statistics I find rather staggering, really. A few years ago, 50% of a company's net profits, that profits after tax, would be paid out in dividends. Now it's about 80 to 90% of the company's profits are paid out in dividends. I heard a talk recently by Xavier Rollet, who's the CEO of the London Stock Exchange, and he was criticising share buybacks, saying that if companies have enough cash, they shouldn't be paying it out by share buybacks to shareholders. Why aren't they investing in the business? They're there to develop a business. They shouldn't just be cash cows for the shareholders. And what it means, of course, and it also means when they're paying out very large amounts to their executives, this money is not being used to fund research and development and investing in people and skills in those companies. And there is evidence of that, clear evidence of that. And of course, the allegation is that part of this is directors wanting to increase the share price, the market price of the shares, because that helps to get their bonus scheme, get their return on their long-term incentive schemes through shares. And then, of course, there's the obvious cases of RBS putting customers out of business, supposedly. I think that's subject to criminal proceedings at the moment. BP cutting costs, Bluewater Horizon, Volkswagen emissions scandal, so it goes on. So it's not surprising there's been a loss of trust and confidence by society in banks since 2008 and the corporate world generally. Interestingly enough, Sir Win Bischoff, who is a very respected figure in the city and now chairs the Financial Reporting Council, his view on the Brexit vote, because we're all scratching our heads here still on why people voted to leave the EU. He said, I think the motive of Brexit in this country was people voting against business. It wasn't about mistrust of politicians. And that's someone who's had his career in the city. And he was talking particularly in the context of controlling executive pay to win back public trust. So what are the causes? I think it's worth, Michael and I have studied this for some time, going back to look at this briefly. Companies, we know, Colin Mayer said, a brilliant invention, a very simple invention. They're legal entities with some characteristics of individuals. For instance, they can buy and sell assets, develop a business, take on debt, sue and be sued. But of course, they have no personality and no soul, and therefore they have to be run by somebody. They're run by directors appointed by the shareholders. Under English law, shareholders always have a right to dismiss the directors. There are arguments as to whether the directors are agents of the shareholders, but that's not accepted generally under English law. Now, the shareholders have an ownership interest in the company. They own the shares. They have certain rights, for instance, to vote on appointment of auditors, approval of auditors, remuneration packages, the AGM. They don't have full ownership interest. That means, of course, they can't force the company to sell assets. They have no interest in the underlying assets or business of the company. Now, unlimited liability, and this is where after this it went wrong, originally meant the shareholders would have personal responsibility if the company failed for its debts and liability, in the same way as if it was their own business. So if you and I run a plumbing business, electricity business, engineering business ourselves, we would have to accept that if something went wrong, we'd have personal liability for the debts. And the same way that originally with companies, you could have shareholders there, but they would be liable for the underlying debts. Now, this led in Victorian times to the introduction of limited liability because people wanted to invest in merchant companies, in particular shipping companies, and make a financial return or risk a financial loss, but not be involved in the day-to-day management. So limited liability means, of course, you all know, that shareholders lose the value of their investment, but are not responsible for the debts and liabilities of the company itself. So it can be said that it means that the shareholder liability is limited, and they go into it knowing that, but it's not limited for creditors. They lose everything, of course, and they extend their credit or not, as the case may be. So the Victorians, who knew a thing or two about a lot of things, a lot of them expressed considerable concern about this and said it was the end of any moral standing in the corporate world. And to some extent, we have the significant effect on us nowadays of their statements and what they did at the time. Now, of course, once you separate the shareholders from the operation of the company underneath, you then develop, if bankers can see, or brokers or investors can see an opportunity for investment, they'll take it, and therefore the share market's developed, and then you have derivatives and so on. So shares being traded as a commodity, purely looking at the financial return. And so we all would have investments, in this country, I'm sure in other countries as well, in large companies through our pension funds, through our own individual investments. So you create an extraordinary chain of relational distance, which is the opposite of relational proximity, between us as the capital providers, our money, okay, indirectly through pensions, but directly through our own investment. And I got investment through my bank in various underlying investment funds. But I haven't a clue where that money is, and I take no responsibility whatsoever, and no interest, I'm afraid to say, in what's happened to those companies, how they're treating their employees, how they're treating the suppliers, given these examples. So there's a huge relational distance. And even if I invest directly, then very often the shares are held in nominee names, and I won't go to the AGM. In the 60s, about 50% of the listed company shares were held by individuals, but now it's about 10%. And of course, a lot of other institutions, sovereign wealth funds, hold shares in companies in this country as well. So we get this odd anomaly that directors who don't own the company are appointed by the shareholders who have the ownership interest to operate the company on their behalf. And shareholders have no responsibility for the company's operations, how it treats its employees and suppliers. But, and this is the key, we as shareholders, through the intermediaries, demand short-term, ever-increasing financial return. And people blame the directors sometimes, but actually it's not their fault. They're encouraged to pursue that route and not to go for long-term planning, the steady investment in the development of the business, not to have long-term plans. They may say they have, but they've got the shareholders on their back, demanding ever-increasing payments. And the shareholders therefore have no direct relationship with the company, because they're a disparate group anyway. And one of the politicians said, shareholders in companies taking no responsibility are like absentee landlords, and companies are effectively ownerless. Now, over the last few years, Michael's been talking about it longer than I have. He had a group in the city talking about this when I came in. Over the years since then, there's a gradual recognition that there is a concern about this. So business leaders, politicians, economists, academics and opinion formers increasingly voice their conviction that change of approach is needed, away from the short-term financial-driven shareholder-focused approach towards recognising and embracing the value and interest of all stakeholders. It's said that 80% of the value of companies is in intangible assets. That's beyond purely financial profit and includes values of the relationship with stakeholders. I won't give you many examples, but Andy Haldane, who we met last year as Chief Economist of the Bank of England, spoke of this and talked about reinforcing and broadening the purpose of companies to better reflect their broader societal role, their role in serving stakeholders, plural, as well as shareholders. There's nothing wrong with making a profit, but we think you should work in the interest of all stakeholders. The evidence is that so purposed, companies create extra value, not just for their staff and customers, but for their shareholders too. And one of the senior people at McKinsey talked about this. Executives must understand that capitalism is not a zero-sum game. They need to recognise that serving the interests of all major stakeholders is essential to maximising corporate value. Lord Brown, who wrote a very good book about corporate relationships, he was former CEO of BP. The logic is simple and compelling. The success of a company depends on its relationships with the external world, not just customers and investors, but also employees, regulators, politicians, activists, NGOs, the environment and technology. Now let's look for a second at what we have in this country and why my hopes were raised last year and somewhat dim now. The framework here, where companies are encouraged to look at the interests of all stakeholders, not just short-term financial return for shareholders, is contained in our legislation, section 172, remember that section of the Companies Act. I think I've drawn that into Michael. Companies Act 2006, 172. I think it's 172. And it refers also to section 414 of the C, which is a strategic report the directors have to write. And what it says is the directors must act in a way they consider would be most likely to promote the interests, to promote the success of the company, okay, the success of the company, for the benefit of members as a whole. That means the shareholders. Okay, well, that goes back to shareholders again. But then we've got what we call the enlightened shareholder approach, which says having regard to particular stakeholder interests, and that's expanded on, but it includes employees, suppliers, and customers. And the UK Corporate Governance Code, we think this might be addresses matters such as appointment and remuneration of directors, appointment of auditors, etc., but there's no reference, and I've scoured the Corporate Governance Code for this, there's no reference in the Corporate Governance Code to stakeholder interests. Whereas in South Africa, and I promote the interests of South Africa, in their King Code, we're on to King 4 now, that's Mervyn King, sort of doyen of corporate governance, they put stakeholders right at the heart of company decision making, what they call the stakeholder inclusive approach. My hopes were raised by a green paper, a consultation document published by the government in November 2016, which included discussion proposals on strengthening the employee, customer, and wider stakeholder voice. They had in it a statement saying they recognised there were economic benefits for bringing external perspective to bear and in understanding and maintaining healthy relationships with interesting groups. Hooray! And in our comments, Michael and I put in comments. Here they are. They're on the website, the Relational Research website. We suggested that in order to recognise the importance of this, an executive director should be appointed to oversee relationships with stakeholders, and they should be reporting on relational matters such as the quality of relationships between the company and its stakeholders. They suggested in the Green Paper there should be a non-executive director to do this. Our argument was that non-executive director means, by its terms, part-time, and not somebody who gets right into the company. They're meant to oversee it from a broader, higher perspective. Now, what happened? The government last month, just a few weeks ago, published its response to the consultation. And those of you who know the politician MP in this country, Jacob Rees-Mogg, will recognise it when I say it's rather thin gruel. He quite carefully goes through, in a very thorough report, the comments. There were 375 organisations put in responses to the Green Paper, and a lot of individuals as well as that. And they, in the press release, said it would be a world-leading package of corporate governance reforms announced to increase boardroom accountability and enhance trust in business. I'm not so sure. And I think politics has come in here. UK people would know what I mean, given what happened in the election last year. The more radical views have rather gone, I'm afraid. There are issues. It's sort of tinkering at the surface, really, isn't it? There's going to be a published register of companies where at least 20% of the shareholders vote against executive remuneration packages. They're going to have to publish the ratio, a lot of companies do this anyway, between the CEO's pay and the average pay. But this isn't going to change the culture of companies, isn't it? It's just a sticking plaster approach. There was a strong approach, they said, to say that engaging with stakeholders would help to improve boardroom decision-making and deliver better and sustainable business performance. And the companies need to accept that they have a responsibility to employees, suppliers, customers, and wider society. So there will be secondary legislation to require companies to explain how directors comply with Section 172 requirements. And then it's been delegated to various groups that, again, I won't discuss this here, but they're sort of city groups, to see how some of this can be brought into from a practical point of view. And the Financial Reporting Council, which is in charge of the Corporate Governance Code, they're going to look at ways in which companies can engage with stakeholders. And they're going to consult on a new code principle, this is quite significant, to establish the importance of strengthening the voice of employees' non-shareholder interests. There has to be one of three, or more than one of three, employee engagement mechanisms. Non-executive appointed, as I mentioned, but looking after the interests of employees only. Could be an employee advisory council, and one or two other possibilities to try and bring the voice of employees to the boardroom. But it doesn't have that sweeping endorsement of the recognition of value of stakeholder interests and how that can enhance the performance of companies and enhance the reputation of companies. So I think it's a bit disappointing, but there is still scope to us to work there. Michael and I will no doubt be working on that. There is a danger, of course, and this comes back to the relational issue, that if you have more law and regulation, it simply leads to a mechanistic and formulaic approach to compliance. It's box ticking, and that of course adds to costs and stifles innovation, stifles the entrepreneurial spirit of companies. They feel they're bound in. And I believe that the government has to provide the framework through law and codes, but the standards in the private sector should be led by the companies themselves and led by the shareholders, who should take more responsibility for the action of the directors and how they treat employees, suppliers and others. So how does this fit in with the relational approach? Well, as we know, it analyses the structure of relationships and suggests practical ways to put relationship priorities at the heart of society, in contrast to a focus on the rights and interests of the individual within a narrowly materialistic worldview. Is that a good summary, Michael?
It's a good start.
It's a good start. It reflects Christian values, and I'm not going to expand on it there, but it's very much taken from the Bible and biblical teaching. And also the fact that we should all be seeking harmony in society. We should all be trying to help others and promote understanding, mutual respect, shared goals and values. It's explained very much by I've worked on various matters in South Africa. In Africa, the Ubuntu principle, and there are those who know this much better than I do. But as explained by Desmond Tutu, it's that I'm me not because of myself, I'm me because of my relationship with you, and we're who we are because of our relationship with each other. We're not individuals, shouldn't be looking for our own return, we should be putting others first. And I think we should accept a responsibility in stewarding our own money, our own funds, our own investments, our own jobs, to try and influence big businesses, coming back to the main principle, and to encourage companies to be more responsible to society. And we can do that, as I'm going to suggest at the end of this talk, in our own limited ways, investors and customers. Now, how do I apply the principle to the corporate world more specifically? We've looked at how corporate structures have developed, as I've mentioned, and we've looked at we've given a critique of the current tendency for short-term financial-driven approach, and how companies can be encouraged to serve the interests and create value for all stakeholders, including shareholders, no reason not to make a profit. And we believe that would encourage a mix of skills and values of all those involved in working with or working for companies. And we think that a community and alignment of interests, by putting stakeholder interests at the heart of company decision-making and operations, would lead to increased productivity, sustainability, competitiveness and profitability, as well as attracting loyalty from employees, customers and suppliers. It's pretty obvious, isn't it? If you pay employees properly, if you listen to them, if you incentivise them, they're going to work harder, they're not going to leave, you're going to have a lower turnover and lower cost to the company, apart from anything else. And we think that listed companies can be assessed through work we've carried out as to the extent to which they have a relational ethos. And this will be based on their published report and accounts, and there's corporate social responsibility in other reports. And one attraction of our approach is it doesn't need any change of law or regulation. And this will be promoted through the Relational Business Charter. And there are 10 principles here, and in summary they will be that companies have a relational goal put in their constitution and directors' statements as well, and evidence of practice within training, with training as to what it means in practice, that they would have a relational approach. And they'd have a disclosure of its policy towards stakeholder recognition and relationships, an analysis, and a report on the quality of those relationships, which Tim was talking about before. There'd be active dialogue with stakeholder groups. For instance, instead of just having one AGM with shareholders, they'd have quarterly meetings in different parts of the country, different times of day, so working people can go to the meetings in the evening. And they'd have not only shareholders, but also other stakeholders, employees there, suppliers, customers. And they'd have an opportunity for breakout meetings to meet the finance director or a finance HR director on human resource matters, the relational director on relational matters. And they could meet the directors face to face, not just lecturing like I'm lecturing now, as happens at AGMs, but sit down and look them in the eye, and that builds up trust and confidence. Under the Relational Business Code, the Relational Business Charter, we'd encourage individual direct holdings of shares, because that would encourage the relationship directly between the company and the directors. We'd encourage long-term holding of shares. At the moment, you know, many shares are held for a nanosecond through computer dealing, and we would want to encourage, by giving extra shares, people who hold shares for, say, 2 years. And they'd be encouraged to come and talk to the company. They'd be mentioned in the report and accounts. Needless to say, employees would be encouraged and incentivised. Pay would be above the living wage. There'd be bonuses. There'd be share incentive schemes for everybody, not just the chosen few. They'd have office activities. And I've come across this recently where one of the big firm solicitors with a bank had a musical in the East End of London. And there were partners performing this with trainees and other people. And you would have an office choir, sport activities, to bring people together, to meet each other, not just in a work environment. Listen to employees, seek their views. We'd all lead to engagement, improve productivity, and lower absence through illness, as I said. Reduce pay differentials. We suggest 20 to 1. Now, that seems quite a significant change. David Cameron, remember him? He said that before the 2010 election, there should be 20 to 1, which is what we said. JP Morgan, still a respected banker from the 19th century, said anything greater than 20 to 1 leads to lower morale and disincentive. Jeremy Corbyn, Labour Party, in their election manifesto, talked about 20 to 1 in the public sector, and those trying to get contracts with the government. We would say under the Charter that suppliers had to be paid on time. It should be within 30 days, not 60, 90, 120 days. They should be paid within 30 days at a maximum, and they should be paid on time. And if they're in financial difficulties, the company, the customer, should help them. They should work more as a partnership, help with their IT, for instance. There should be personal and prompt dealings with customers, swift, personal, effective complaints procedures. And that would encourage customers, of course, but it also puts together a relationship, ringing for a complaint and actually speaking to someone. It makes an enormous difference, doesn't it, if you actually talk to somebody. We keep debt levels under control, a low debt to equity ratio and a high profit to interest ratio. And if there's going to be a debt increase, only one of my clients had this, there would have to be consent from shareholders to have a debt increase, and an understanding of why that is. Some companies apparently borrow just purely to pay dividends. Boodles, you know, Boodles privately owned family company, the jewellers, they have vast array of jewellery in all their shops, but apparently they have no debt. How they do that, I don't know, but it's a Christian principle behind it. Then obviously we expect companies to fulfil their obligations to local and wider society, give time off to employees to support community activities, and we'd expect companies to pay tax in the country where the profits are earned. There would be an assessment by an independent body as to how companies rate, and we've got a method of doing this, against the Relational Business Charter. That would be discussed with the company, and if there's more information required, we'd ask the company to publish that, and they'd be given a mark out of 100 or a kite mark if they get over a certain level, and that would be published. And the benefit of that is, of course, people can compare companies within sectors. At the moment, you can't compare companies and how they perform on CSR, for instance, although I would say that a number of people don't rate CSR particularly as effective, and it certainly doesn't really get to the heart of the relational approach we expect companies to follow. And then you could compare sectors, companies in different sectors, as I say, and you're effectively rewarding those. You're acknowledging the ones who rate highly on a relational basis, and the others who aren't doing so well, you could explain to them what it means and encourage them to adopt this ethos. And we believe over time it'll be shown in their results. It'll be certainly shown in people wanting to work there, people wanting to invest there, people wanting to deal with those companies. Now, you could say this is all a bit far-fetched, isn't it? Well, why not compare it with fair trade, which came out of nowhere, I understand, through a Christian beginning. And now companies are queuing up to have the fair trade logo applied to their products. Now, I know there are some questions about fair trade, but it's now part of accepted culture in this country, and people search fair trade goods when they go and shop. And people believe, I think quite rightly, that it's helping the interests of small-scale farmers and workers in Africa, Central America, and parts of Asia. Now, why aren't we shopping to support people all the way up the chain in supermarkets, or shops, or investing our money with banks, or whatever? As I say, we take no interest in that, do we? It's all explained in some detail in the booklet Michael and I wrote, and we run out of copies pretty well, Transforming Capitalism from Within, and another article I wrote was a law lecture from UCL. They're on the relational search website. Now, finally, I want to say that we want to start, a movement. I said it originally as a Christian movement, but it could just be a movement generally, like there has been a movement for to support fair trade. Now, I've written about this for the Kirby Lang Institute for Christian Ethics. I'm sure you've all seen that on their website. I do have a number of copies of that, if you would like a copy. So what I say is, in our workplace, we can show leadership by encouraging high standards of company behaviour, not only as to good faith, honesty and ethics, which of course we'd all expect, but also recognising, understanding and promoting the interests of employees and all other stakeholders, including shareholders, and encouraging within our organisations the value of recognising that, and as Tim would say, measuring it and understanding what it means, the value that will bring to everybody working together as a community of interests. And what I say is that a number of us could get together, or just as individuals. Anybody can buy companies in BP, Shell, Marks and Spencer, Sainsbury's, whatever, all these listed companies. These are companies we deal with every day. And we could write to companies and say, do you pay your suppliers on time? They publish, I think, the average payment to suppliers, which doesn't mean very much. And if you don't pay your suppliers on time, why don't you pay your suppliers on time? Do you pay all your employees at least a living wage? Explain your policy on 0 hours contract. And we as individuals or a group could go to the AGM. We don't do that, do we? And ask questions in public and talk to the press if necessary about this. And some companies will be fine on this, and they should be recognised as such. So publicity should be given to companies who meet these standards. And we could also, as consumers, as I said, we buy goods because they're cheap very often, or because we like the quality of them. We don't think about how the company's treating the employees in this country and overseas. If there was an index, a register to show how these companies rate as to their relational ethos, we could then start buying our goods and services and use banks at companies which rate highly and explain to the company why we're doing that. And that would be akin to the sort of fair trade approach. And we'd arrange for there to be publicity through the news and social media, and profile raised of the whole, to educate people on this, to educate people that we have an interest in the companies, because most people well, you understand it, but most people, I'm afraid, don't understand that we have an interest in these companies as employees, as investors, and as customers, consumers.
Excuse me, Jonathan, I have a question. You did invite us to jump in.
Jump in, I've almost finished. Jump in.
For a lot of us here, I'm sure this rings so true to what we know is needed. The question I often ask is, why are we having so much trouble getting more traction? Is it just that human nature is so base and people are more interested in profit, or are we not talking to the right people? And I just wonder, there might be others who have views on this as well. Perhaps I could help to coordinate a little bit some questions for you to take advantage of the space, if that's okay.
Can I just take, I think, 1 minute longer?
Absolutely.
Okay, and then I'll finish. I have to finish, but I think taking your point there is we need to recognise that as investors, customers, and communities, they can influence the behaviour of large companies. And I think there should be a move to encourage compliance with the Charter's principle. And then if we could encourage companies to adopt a relational ethos throughout their companies, there will be huge benefits that follow. So I think that's it really. I think there should be a greater recognition that takeover interests need to be valued and nurtured and reported on. Given them, there is a gradual trend, as I've said, to move away from relying purely on financial reporting, and IRC and others, of course, are looking at this. If this value can be measured, it can be improved, and not only the company, but all stakeholders in the wider society will benefit. And I believe that shareholders should take a greater responsibility to hold directors to account. After all, as I said before, they have power to dismiss the directors and encourage them to steer their companies responsibly. And as I look at this in a positive way, a lot of companies would come out well on this, but we want to encourage the others. And what we need is not so much sticking fast and looking at particular limited aspects. We need to encourage a change of culture. And what I was going to finish with, is exactly your point. Let's start a debate. Right, here's now start the debate. Thank you.